If you're a first-time homebuyer and planning to buy a house in 2026, there are two things you need to really understand: your down payment and your interest rate. The interest rate is all about timing, which I'll break down for you here in a minute. I'm Brandon Brodsky, and I've helped over 10,000 families buy homes, and I can tell you the big savings when you buy a house are in the little details that I'm going to explain. First, let's talk about your down payment. So when most people connect with me initially, they think they need anywhere from 15 to 20% down on a home, which is just a myth. You actually don't need to put that much down on a property. And most people don't even have 15 or 20% to put down. You can put 3% down if you're a first-time home buyer, 5% if you've owned a home in the past. So you don't have to eat up all that money that you have saved for your home purchase, or maybe money you don't even have saved, right? It's gonna stop you from having to wait if you're not in a position to put 20% down. So what I wanna show you is ways that you can put down less money, and I'm gonna compare those payments to what they'd be if you had that 20% to put down on the property, just so you can see how little the difference might be from one payment to the next. And from there, I'm gonna show you some strategies to reduce that payment even further. So let's first look at what things would look like if you're putting 20% down. This is if you're able to, or if you were just, willing to put 20% down. So let's just say hypothetically that you were gonna buy a home for $500,000. Now I'm using PP, purchase price. That's what my PP stands for right here, 500,000. Now we said you're gonna put down 20%, and then you have your down payment right here for 20%. So 20% of 500,000 is $100,000. I'll put a little note here that that's 20%, just so we remember. So if you're buying for 500, putting down 100, well, that means your loan amount, LA, would be $400,000, which is the 80% that you're borrowing. Loan amount, 400,000, 500,000 minus 100,000 leaves 400,000. That's what you're borrowing. Now, let's see what a monthly payment would look like on a $400,000 loan for a $500,000 property. And let's assume that we're using a 30-year fixed rate mortgage to do this. So we're gonna say 30 years. Now, just for this exercise, let's go with you having a 760 or above credit score. Now, I know you may not have that, and I can get into programs that are better for someone with lower credit scores, but for now, we'll use that, which would be top tier for a mortgage. And in today's market, you're looking at an interest rate for a 30-year fixed rate mortgage somewhere around 6.125%. So let's just say we're 6.125% on this 30-year mortgage. Now, I wish I could memorize what the payments would be, but I can't, right? So I'm gonna use a mortgage calculator. And by the way, you can get mortgage calculator online. It's really simple. You can just Google mortgage calculator, and you can fill in all the data points yourself as far as the loan amount, the purchase price, and so forth, the interest rate, and you can determine what your monthly payments would be on your own. It's an easy exercise to perform on your own. So we said the loan amount's 400,000 at 6.125 over 30 years. So I'm gonna do 400,000 loan amount, 30-year term at 6.125%. What that number is gonna give you, is principal and interest, which is PI, of $2,430.44. And this is monthly. So this is your monthly principal and interest payment. But your monthly payment on a property is made up of more than just principal and interest. So what we're gonna do is we're gonna factor in property taxes. You have to pay taxes on the home. And we're also gonna factor in insurance, which is homeowner's insurance that you have to carry on the home. So for a $500,000 home, we're gonna use a tax amount of $750 per month. And for insurance, we're gonna use $350 per month. Now, these two numbers on this house are gonna be the same regardless of how much money you put down, right? So, and that's always gonna be the case. Those two variables, whatever house you buy, it doesn't matter how much money you put down on that house, your property tax bill and your homeowner's insurance will be the same amount for that house regardless of your loan amount. So keep that in mind. So in this case, these two numbers together add up to $1,100, right? So that's gonna be what we add on top of your principal and interest payment in all of these scenarios we're gonna run. So what we do is we take the $2,430.44, we add it to $1,100, and that's gonna give us $3,530.44 per month. And just so you know the acronym, this is your PITI, principal, interest, tax, and insurance. You may buy a home or a condo that has an association fee you have to pay on top of this, but we're just gonna use principal, interest, tax, and insurance for our calculations. So $3,530.44. So what I'm gonna do is I'm gonna put this up here as a reminder for us. 20% down, we said is $3,530.44. I'll end my comma, so at least I'm writing things out properly for you, easy to understand. So this is our first scenario. We're gonna do some comparisons. All right, and I just wanna show you, for one, we know at a minimum that this $100,000 is what you're coming out of pocket. Now, on top of that, you're gonna have closing costs. You can watch some of my other videos where I get into details on what those are. But for now, we're just gonna focus on the down payment portion. So you have $3,530.44 per month. and then you have $100,000 for your down payment, right? That's that first scenario. Now I'm gonna erase this. I'm gonna leave the purchase price because we're really just gonna be changing the down payment and the loan amount for the second scenario. We're gonna still have this. This remains the same. Like we talked about, taxes and insurance are still $1,100. This is gonna change. So I'll leave this on the board so you can see, make it nice and easy. Okay, so for the second scenario, I'm gonna go with the most common down payment I see with my clients, which is 5%, 15% less. So our down payment at 5% of $500,000, that hasn't changed, is $25,000. That's a 5% down payment, which means your loan amount is now $475,000, which is 95%. Now, there's a couple of things we need to factor in here. So we know tax insurance is the same as I already stated. Throw my eraser down real quick. Get my old mortgage calculator out. The interest rate, believe it or not, is going to be the same at 5% down than at 20% down. As a matter of fact, it may cost you a little more at the 20% down. I've talked about that in other videos. But we're going to use the same exact interest rate to do our calculations because it should remain the same. So we're going to use a 30-year at 6 1/8, but this time your loan amount's $475,000. So this is going to give us a principal and interest payment of $2,886.15. Now, here's something that's extremely important. You have your principal, interest, tax, insurance, but now we're putting less than 20% down. And I mentioned mortgage insurance, right? Mortgage insurance is something you have to pay as part of your monthly payments when you're putting less than 20% down using a conventional mortgage, which is what this example represents, right? These are conventional mortgage options that I'm showing you. Now, there are ways to eliminate that mortgage insurance by getting a seller credit and paying it all up front. I've talked about that in other videos and ways to reduce your costs. I'm not going to get into it now, but just keep in mind, you don't necessarily have to pay this monthly mortgage insurance depending on how your offer is structured when you submit it for a property. You're going to have mortgage insurance, we'll call it PMI, private mortgage insurance, on this. Now, mortgage insurance can vary depending on your credit score, right? The better your credit is, the less expensive the mortgage insurance is. If you have more than one borrower, right? Let's say you have a spouse, it's two of you on the loan, the mortgage insurance actually gets a little less expensive because it reduces the risk in the eyes of the mortgage insurance company. I'm gonna use a hypothetical number here. We said you have 760 credit. So I'm gonna say that the mortgage insurance is equal to 0.6% annually. So how do I figure that out? I'm gonna take this $475,000 loan amount. I'm gonna multiply it by 0.06, which is 0.6%, divided by 12. So we're gonna use, for mortgage insurance, we're gonna say is $237.50, right? And we said this is 0.6% for the mortgage insurance. So now what we're gonna do is we're gonna add up our total payment. So we take $2,886.15 plus the $1,100 for taxes and insurance. We talked about that stays the same, plus $237.50. So in total, the payment on the same home, putting down 5%, is $4,223.65. So I'm gonna put this here, like I said I would. This way we can compare. $4,223.65, and then we have $25,000 down payment, right? There's a difference in the payment of $700, but there's also a difference of $75,000 between your $100,000 payment and your $25,000 payment, which is pretty substantial. Think about what you can do with that $75,000. What you need to compare for yourself is if you're in a position to put down 20% and you're considering maybe a lesser down payment after watching this, what can you do with that $75,000 difference in the down payment? Can you invest it somewhere and actually earn interest on that? So you choose what you want to do, but the options are there. That's the most important part. I'm going to show you one more comparison at 10% down, just so you can see the difference there, because there's a couple of variables that are going to change. The cost of mortgage insurance is actually going to decrease because on top of credit score being a factor in what the cost of mortgage insurance is, your down payment is as well. The closer you get to that 20% number, the cheaper the mortgage insurance gets because the risk keeps going down and down as you put more money down. So let's remove the principal and interest. Let's go ahead and change our down payment. And of course, when we change our down payment, we're going to change our loan amount to match. So now we're saying we're putting 10% down. So 10% would be $50,000, which means your loan amount would be $450,000, which is 90% of the purchase price. So now all of our numbers are going to be based on that. Once again, the rate will be the same. So we use a $450,000 loan over 30 years, 6.125 interest. That gives us principal and interest here of $2,734.25 every month. Once again, It's less than 20% down, so we have to pay mortgage insurance, right? PMI. But the PMI is going to be cheaper because you're now putting 10% down instead of 5% down. So what we're going to use for our calculation here is we're going to say that the mortgage insurance is going to be 0.3%, okay? So the way we calculate that is we take the $450,000 loan amount times 0.003, which is 0.3%, divided by 12. So we're going to say that the mortgage insurance is $112.50 a month. Once again, we're going to add everything together, 2734.25. And you can use a piece of paper, follow along with me if you want to do the math for yourself, or you want to use the mortgage calculator that you downloaded. Hopefully, calculator's going haywire. 1,100 for taxes and insurance. I said 11,000. Let me do this one more time. This is a lucky one, I feel it. 112.50. So your total payment with 10% down on this home is $3,946.75. So I'm going to write this up here just for comparison again. $3,946.75. And then we said your down payment is $50,000. So I'm not going to go further than this as far as down payments are concerned, but I just want you to look at the differences here. So if you're considering 20% down, which is going to require you to come out of pocket a minimum of $100,000 because that's your down payment, your payment's $35, $30, $44. If you jump to 10% down, so you cut that down payment in half, keeping $50,000 in your pocket, right? Because 100,000 minus 50 is 50,000. You would have kept it in your bank account to do what you please with. Your monthly payment is about $400 more per month. If you want to keep even more money in your pocket to do what you please with, then you would go 5% down. Your payment is $700 more than it would be at 20% down, but you're keeping $75,000 in your pocket that, once again, you can invest it, you can use it for home improvements, whatever you think. Maybe you want to put a pool in the home and you didn't have one. You can use that $75,000 toward that pool, and that's actually going to increase the value of the property. So keep these things in mind when you're trying to make your decision as to how much money you should put down on your home. Now, we have an idea of what payments are, and we're basing everything off the 6.125 interest rate. But how do you get those payments down? And is there a way to get this rate down other than waiting for the market to improve and for rates to come down, right? Because you don't want to do that necessarily, because what's going to happen if you're waiting on the sidelines for interest rates to come down before you buy, well, you're likely going to see home prices go up at the time that those rates come down. What I recommend as a way to reduce your monthly payment is a different strategy altogether. So let me erase all this. I'm going to show you what that strategy looks like. And the strategy works for any of these scenarios, 5% down, 10% down, 20% down. That won't change anything. Still gonna be a $500,000 purchase price. So here's the deal. The strategy is going to be asking the seller of this $500,000 property to give you a credit toward your purchase. And that credit is actually going to go toward the cost associated with your purchase. It's called a seller credit or a seller concession. It's the same thing. And I'm going to show you how to use that concession in just a moment. But first, let me show you how it works. In these scenarios right here specifically, which is a conventional loan with 5% down, 10% down, and 20% down. When you're putting 5% down on a property, and I'm going to write seller credit here. When you're putting 5% down, you're allowed to get a 3% seller credit. And I'll show you what that means in a minute. At 10% down and 20% down, you're allowed to get a 6% seller credit. So what does this even mean? What it means is you take this $500,000 purchase price and you multiply it by either 3% or 5%. 3% of 500,000 would be 15,000. 6% of 500,000 would be $30,000. This is money the seller of the property would give to you to help cover your costs associated with the purchase of the property. And you may be saying to yourself, well, why would the seller ever agree to give me that money? Well, most people that are purchasing a home think they want to get a deal on that home by reducing the price of the property. And I guess that would be a good deal, but it actually makes sense more often than not that rather than reducing the price of the home, ask for a credit from the seller equal to what that reduction would have been. If the home originally, let's just call it, is $500,000, and you were going to say, hey, I want to go ahead and reduce the price of them to $485, that's going to make a minimal difference in your monthly payment. I'm actually going to show you what that would be. So let's just use the 20% down number for right now. So we said our loan amount, if you put 20% down, would be $400,000. If you did a $485,000 purchase price because you asked them to reduce it by $15,000, right? This, and we're doing 80% of that. So let's do 485,000 would be 388 loan amount instead of 400,000, which is what it would be at the 20% down on 500,000, right? You did a reduced price. Let's look at the difference in the payment. $388,000 at 6.125 interest over 30 years. So the difference, the monthly payment there would be $2,357.53 per month for principal and interest. Oh, Matt, let me add the tax and insurance on here for you. We said it's $1,100 for taxes and insurance. So we're talking $3,457.53. So look at the difference in the payment. $3,457.53, $3,530.44. So this is less than 180 bucks less, 70 bucks less per month by reducing the price by $15,000. But what if instead of reducing the price $15,000, you took this $15,000 as a seller credit while paying the full $500,000? And let me show you how you would use that. So this seller credit of $15,000 at the full price, we would use this for something called a temporary rate buy down. This does two things. It does reduce the rate, but when the rate goes down, so does the monthly payment. Now, this is important to note though. This word, temporary, it's not going to be permanently reduced. It's going to be reduced for a set period of time. So let's just say you got the $15,000. That would be enough to cover a 2-1 temporary rate buy down. What this means is that this 2 means that your rate in year 1 that you have the mortgage would go down by 2%. This 1 represents what would happen the second year. And if you follow along, that would mean your rate would go down by 1% the second year. So once again, we said we're using an interest rate for our numbers of 6.125%. To figure out what your payments would be in year 1, in year 2, all we do is we take that number, and in this case, we'll do this first, we reduce it by 2%. So year 1, we'd be at 4.125%. Year 2, we'd be at 5.125%. After year 2, the rate goes to the 6.125% in this example. So it doesn't just skyrocket all of a sudden. You know where it's headed. But what I want to show you is the difference in the monthly payment doing this. So we said the difference before, if we just reduced the price, was about $70. So let's compare now. We're going to do it on the 20% just to keep it simple. So we did $400,000 loan amount, 30-year term. The rate's now 4.125%. This is going to give us a principal and interest payment of $1,938.60, but I want to add the $1,100 for taxes and insurance. So that's going to give us $3,038.60. This is PITI. Remember I said that earlier? Principal, just tax and insurance. That's year 1. Look at the difference in payment. $3,530 versus $3,038. That's almost a $500 difference in monthly payment. Much greater than $70 for reducing the price 15 grand. In year 2, I'm going to show you what your payment goes to. $33.72 for principal, interest, tax, and insurance, right? Still nearly a $200 savings on a monthly basis, much greater than $70 per month. So the point of what I'm trying to show you is that although you mentally might think, hey, I want to get the best deal, I'm going to reduce the price of the property. Well, the resulting monthly payment may not be as great as you anticipated. The best way to reduce your payment and your interest rate is by way of a seller credit that's then used for a temporary rate buy down, which reduces your monthly payment substantially. And here's the cool thing. If you're thinking that, wait, well, if rates drop in the future, I'm going to want to refinance. Can I still do that? Absolutely. You can refinance anytime you want. And here's what's cool about these temporary rate buy downs is that this money that was used for the temporary rate buy down, it gets used up on a monthly basis. It's not just eaten up right away. So if there's any money left over at the time that you refinance, let's just say this is a 2-year period, right? You refinance after a year, that means there's still money left. When you go through the refinance process, this is when you pay off your existing mortgage with a new one, probably at a lower interest rate. That would likely be the reason you're doing it. You get refunded any unused portion of this $15,000 for this specific example. So this is a great way to reduce both your monthly payment and your interest rate simultaneously. And you win in a situation where you thought before you need to reduce the price, and it just wasn't the case. So it's important to understand different strategies that are available to help accomplish your goal. Are you more concerned with the monthly payment? More concerned with your out-of-pocket costs? Are you concerned with everything? So that's why it's important. Just know your options. Don't just go into purchasing a home thinking there's only one way to go about it. If you have any questions or need clarification on anything, just shoot me a comment and I'll get you the information you're looking for.